What's going on? This is Ian Starkey, founder and principal of White Wave Capital, and today I want to talk about what it looks like to invest in a real estate apartment syndication deal. So let's get into it. So as I mentioned in previous videos, we buy and syndicate apartment complexes. And when I say syndicate, that means we contract it and we operate it, and then we raise money from our friends, family, investors, partners, whoever wants to get involved, that qualifies with us to get involved, to can invest in the deal and get involved with us. Simple as that. My mentor Tim said this, and I want to share it with you. There's enough sunshine to go around. All right. The sun casts a huge net over this whole earth. And my thought process with that comment is that if I want to sit outside and get a tan, I think all my neighbors should sit outside and get the same tan I'm getting. And that's how we operate. That's why we do syndication. That's why we want to partner and grow and meet and network with more and more people so that more and more people can participate and get involved in these massive assets and these massive great returns. All right, so let's talk about it. So we have two metrics at White Wave that we stand by when we're buying property. All right, those two metrics are returns. Okay, we are only going to buy a property if we can hit these two metrics for our investors' returns. Metric number one is a 10% average cash on cash per year. What does that mean? That means if you put $100,000 into a property, if you invest 100 grand in this property, you got to make at least 10 grand a year from that property. All right. We've got to be able to at least make a 10% a year cash on cash in order for us to move forward with the deal. All right. That's that. Otherwise, for me, it doesn't make sense. So number one is that 10% per year. So simple math, put 100 grand in the property. We structure as a 10% preferred return, or it's a 10% cash on cash year. If it's 10% preferred return, you're going to make a flat 10 grand a year. If we do, say, an 8% preferred return, you're making 8 grand a year flat. And then also we're going to make sure it makes at least 10% cash on cash. So probably be 8,000 plus another 2,000, 2,500 to hit that 10% minimum threshold. All right. So that's what a 10% cash on cash year is you're at least making 10% a year on your money. All right. The second threshold is a 20% or greater average annual return a year. Okay. That average annual return is taking not only your cash on cash, but also the sale proceeds whenever we project we're going to sell the property and averaging them out over the life of the investment. All right. So let's say we go to buy property A. Property A is a 100-unit apartment complex in Houston, and we're going to buy it at a 6 cap, and we project we're going to sell it at, let's say, a 6.5 cap, or we project we're going to sell it at a 5.5 cap because we're going to really improve it, and the market over there is improving, which I'll talk about after this. But let's say we project we're going to buy it for this price and we're going to sell it 5 years later down the road for this price. All right. Now, when we buy it and sell it, if our underwriting shows that when we sell it, we can make a 20% a year average annual return a year for our investors, we'll go ahead and we'll move on it. We'll put it under contract and we'll start due diligence. If we can't hit that, if the price the broker's telling me doesn't quite hit that 20% metric, I may either, if our price is right below what they're looking for, I'll still send an offer of what we're trying to get it for, or what we're going to bid on it. I'll still put a bid on it. If our price is well below what they're looking for, I'll call them up and say, hey man, just being honest, I know you guys are looking for 20 million. I'm coming in around 15 million. That's what works for us. Let me know if I should put an offer in because I don't want to offend anybody. Okay. Simple as that. So those are the metrics we're looking for, is 10 and 20. I stick to 10 and 20, 10% rate per year, 10% cash on cash, return a year, 20% average per year. Now, what does that average per year look like? So let's do this. So you invest 100 grand into this deal. All right. $100,000. You make 10 grand a year from the cash on cash. Let's say it's a 10% pref a year. So 10% for return a year, that's 10 grand a year. So 10, 10, 10, 10, 10 each year. And then let's say in year 5, we sell it, and our sale proceeds, after returning your initial 100 grand, you have 50 grand on top of that in sale profits, sale proceeds. So let's take that 50 grand, divide it by 5. That comes out to around another 10 grand a year. So 10 plus 10 is 20. So that's a 20% return per year on your money. Okay. That's pretty freaking sweet. That's solid. And a lot of times the deals we're doing and the price we're trying to buy at, we're actually going to make more than that. But for simple terms, 10 grand a year in cash on cash return. In year 5, we sell it. We make a 50 grand profit on top of the 100 grand that you invested. Average that 50 grand over 5 years. That's 10 grand a year. 10 plus 10 is 20. 20% average rate of return a year. So I want to show you guys my underwriting on a deal that just about hits these metrics. So here is my calculator, my underwriting tool, one of many that I use. This is underwriting for a property that I'm actually going to go tour this coming Monday. So next week, because I'm recording this on a Saturday because I love what I do. So here is my metrics, okay? For me to hit the numbers that would work for us and our investors, so 10% cash on cash, average cash flow a year, 20% average rate of return a year, we would have to buy this thing at 9.2 million. All right. The broker I spoke with told me the seller wants 9.7 million, but they could be flexible. It's a stabilized product, so there's really not much value add, but I always, just guesstimate, because after talking with the owner, talking with the broker, and doing a little bit of peeking online, I saw that the property is pretty much stable, and all we want to do is come in there with a professional management team and raise rents. I'm going to put $2,000 a door in renovations and rehab. So that comes out to 200 grand. It's 97 unit building in Houston. So, we're buying it for 9.2, closing cost about 360,000. That's lender fees, legal fees, syndication fees. That's everything encompassed. 200 grand of rehab, 100 grand the operating account. We're going to get a loan for 78% leverage from the bank at 3.2% interest rate. So that's 7.3 million. That's that number. We'll need to raise 2.5 million from ourselves and our investors in order to close. So we'll be all in for 9.8 million. It's not too bad. Now let's talk about it. So based on my underwriting, here are the returns and the metrics that I came up with. Based on the way I'm going to underwrite it and perform it and guesstimate how it's going to operate when we take it over. So equity ownership. Our investors are getting 60% ownership in this asset. So basically, as general partners, we own 40%. Our investors own 60%. So in simple terms, 60% of the cash flow, 60% of the sale proceeds, 60% of the property value is our investors, 40% is ours. Very simple. 7-year average. I do an IRR because investors like that, but I like the average better. For me, it's simple. It makes more sense to me. Let's talk about the average. So the average for this deal, based on our projections, is 21% a year. So that's over 7 years, holding the property for 7 years, sell it in year 7. I project that we'll make a 20% average rate of return per year based on the investment our investors are making. Their equity is going to multiply by 2. So their 100 grand is going to basically turn into about 200 grand when we sell it. They're going to make an average, this is averaged over 7 years, of 10% a year, almost 11% a year based on our projections. They're going to make a 246% rate of return on their dollar. It's incredible. Their total compensation is 6.1 million. Now, that 6.1 million number is coming from the cash flow, coming from the sale proceeds, and that's about it. So over 7 years, we're going to invest, call it, 2.5 million. And after we own and operate this asset for 7 years, we're going to make 6.1 million. That's not including the 2.5 million we invested. So this is a really good deal. I like this deal a lot, and that's why I'm really excited. I'm talking about it. So yeah, there's still some items I'm missing. So I just threw these in here as 1 1s and 2 2s. It's comprised of 1 bedrooms and 2 bedrooms. I don't have the unit sizes of each, so that's why I just took the average. The average size for all the units here is 850 square feet. So I just grouped them together and did the average. This is a very bootstrap underwriting, but I just want to explain it to you guys, show you how I'm looking at things. Right now, the average rent they're getting is $741 a unit. That's for the 1s and the 2s. Market rents average out to around $950 a unit based on other properties in the area. That's over $100. That's over a $200 rent bump. So I'm going to put us at a $100 rent bump because I think that's more realistic and more achievable. And I don't want to shoot for the moon and land on Hawaii. I want to shoot for the star and land on the moon. So we're going to project 850, knowing that the market average is around 950 to 1,000, and we're going to try to hit 850. If we hit higher, it's awesome. If we don't, we're still making money. So boom. So let's go down. So let me zoom out a little bit because there's a lot of numbers I'm throwing at you. So here is my projections for the year. Okay. Now this blue column, this is what our pro forma will look like roughly. This is what it's currently operating at. So let me scroll down real quick. I want to talk about this. So this property is currently operating at a 30% expense ratio. That's very lean, almost unrealistic. Now, talking with the owner, he has a family member managing it, and it sounds like he manages it as well. He kind of has, someone he hired that does management and maintenance, and then he also helps out. He shows up a lot as well. So the payroll is very low. Since we're going to bring a professional management team in, the payroll is going to be a lot higher, and we're going to have a management fee. So that's the biggest two indicators of how our expenses are increasing. I project taxes will increase. I always project property taxes will increase just because we're going to sell it. It's going to probably get reassessed, and tax man's going to say, hey, you bought it for that price, you're paying more. So that's why I say taxes are going to probably increase. Insurance will likely increase as well, unless we can assume their current policy. We're probably going to get a more expensive policy. His operating expenses are very low, and his occupancy is very high. So, this kind of has me scratching my head a little bit because it's currently a stabilized deal. It's got 4% vacancy, but it's renting well below market. So, right now he's making about $830,000 a year from the rent income, another $23,000 from other income, fee income. So call it $855 a year. Because we're going to raise up to close to market rents, we're projecting $914,000 with a little higher vacancy, 8% vacancy. People are going to leave, people are going to come. And then we're going to increase that fee income as well. We're going to start charging pet fees, application fees, parking fees, probably put some covered parking in there. We're going to look for creative ways to add more income to this property. Vending machines, washer dryer machines, ATM machines. We're looking for more ways to make this property print more money. All right, it's the name of the game. So I have expenses increasing about 10% from what he's operating it at, because we're going to have professional managers in there, and it's going to be, most of these are also projections, so I'll need to get rough underwriting. We could operate it at the same cost he's operating at, but to be conservative, because I'm very conservative in my underwriting, I have it increasing to around 41%, which is still very good, very lean for this kind of asset. So let's go down, because that's a lot of mumbo jumbo, and I want you to see how this really works as an investor. So here is our $100,000 partner yields. So if someone were to invest $100,000 into this deal with us, they would own 2.39% of the property. So, you own 2.39% of this asset. What does that look like? What does that mean? So that means that whenever we close, we create a new LLC with us and all the investors as ownership in that LLC. you as a $100,000 partner would own 2.4% of that property. That would increase your net worth by, I mean, immediately that's about 150 grand because we're buying it for 9.2 million. So 9.2 was it 9.25 million? I'll have to go back up there and check. 9.25 million. So let's see, equals that times 9.25 mil. Let's put these in dollars so we can see it better. So immediately that increases your net worth by almost 100 grand. It's incredible. Okay. Now that's not factoring in debt, so we will have to factor in the debt, but your net worth increases immediately as you buy the asset. So let's talk about the money. Let's talk about the cash flow, the returns. So in year one, when we come in and raise rents, this is how that 10% is averaged out. So we project in year one, we raise rents, we raise the income. We'll probably have some turnover, but we'll have more people coming in, get some professional managers in there. That 10 grand investing that will make you 9 grand a year one. We'll put these in cash as well so you can see them better and understand them better. So year one, it's a 9% return. So there is that 9.2% based on the cash flow we projected will make year one. Year two, we have a 10.5% return on investment year two. That's $10,500. Year three, 11%, $11,000. I mean, you see, and you're going to probably ask me, how is it increasing so much every year? Well, that's because each year we're going to raise the rents by 2.5%. We're going to look to raise the income by 2.5% each year. And we're also going to be paying down our debt service. So as we pay down our debt service, we pay down our loan, there's less to pay. So that's why this number increases each year. So if you were to invest 100 grand into this asset, year one, you would make 9,000. Year two, you'd make about 10,000. Year three, 11,000. Year four, another 11,000, 11, 12. Sell it in year seven and make 180,000. Okay. How do I generate that $180,000 number? Well, that is based on our projected sales price. So we're projecting that we're going to sell this thing in year seven for 13 million. How do we come up with that number? So because it's in a hot market and we're actually buying it for an above market cap rate, we'd be buying this thing for 6.5% cap rate. All right. The market cap rate for Houston is 5.5%. So based on the net operating income of 599,000, we divide that 599, this number right here. When we divide that by 9.2 million, that's 6.51%. That's our cap rate. So if we were buying this thing at a 5.5 cap, just to paint the picture for you guys so you understand how cap rates work. So if we were to buy it for a 5.5 cap, I'm going to use this box right here. All right, pay attention to this box. I'm going to highlight it so you can see it. So this box right here. So this is, if we're buying it at a 5 cap, let me see, 0.055. If we bought this at a 5.5 cap, if we bought this for a market value, we'd be buying it for 10.9 million. But because we're buying it for a 6.5 cap, see that 5.5? Let's say we bought it for a 5 cap, even more. We're buying it for 12 million. So we're not paying retail for this property. We're not. Retail is 5.5, is 5 to 5.5. I've even seen properties sell for 4.5, 3.5% cap rates. You know, the lower the cap rate, the higher the purchase price. Let's say we were to buy this thing for a 9 cap, which would be a smoking deal. We buy it for 6 million. I'd love to buy it for a 9 cap, but that's just not going to happen in Houston. So the lower the cap rate, the higher the purchase price. All right. That looks weird. Let me fix that. It's going to bother me. There we go. So we're buying it for a 6.5 cap, which is awesome for a Houston property. It's absolutely incredible. And we project that each year, we're going to look to that cap rate's going to decrease a little bit each year. So we project in year 7, Houston's still going to be a great market, great multifamily products, still having a great job growth, still things are operating and moving and improving as they are now. We project we'll be able to sell it at a 5.8 cap. That's how we're coming up with that $13 million valuation. We sell it for $13 million, subtract the debt. That's how you as the investor will make $180,000 in year 7. Not including the $100,000 you invested. So that's subtracting this number. So you look at the equation, that's subtracting this from your sum, or that's subtracting this from what you're going to get at the sale. So yeah. So that is that. We buy it, we own it for 7 years, and then we sell it, and we make a big chunk of change. And whenever we sell it and get that chunk of change, we go buy another one. We buy another asset. We buy another apartment, another RV park. Whenever we sell our properties, that's whenever you also want to be the most strategic, because, you're sitting on $180,000 of profit. What do you do with that? Well, number one, you can either let it go to your bank account and you can pay Uncle Sam your capital gains tax, which will take your return down quite a bit. Or you can now 1031 that other money, that 1031 that money into a new property. All right. I'll have another video on that, but thank you so much for spending the time with me. This is why I love real estate. You can literally take your money, put it in a property, put it in a cash flowing asset, let it make money for you every single year, sell it, have a big chunk of change, and do it again. Keep doing that over and over and over again. You take $100,000, let it grow over 7 years to $180,000. Take $180,000, put that in there, let it grow into $230,000, $250,000. Probably more realistically, it'll probably grow to about $300,000, and just keep doing that. Okay, keep doing that over and over and over. Rinse and repeat. You know why? Because each year you're getting cash flow. Each year, each month, you're going to get that check that comes in. Live off the check, let the money keep growing. Live off the interest, don't spend the principal. All right. Thank you so much for spending the time with me. Thank you for watching this video. If you want to learn more about White Wave Capital and our upcoming investment opportunities, click the link below. Either book a time with me on my calendar or fill out our investor questionnaire. And stay tuned for the next video.